Hi, it's Lee, and welcome to the Tesla Economist. Alright, so we just saw the price drops we were expecting in the US market. I don't believe there is anyone still denying demand for Teslas is down now that we've seen all these recent price drops. I estimated that the Model Y long range would drop to $52,500, so I was pretty close, as it is now $53,000. Low enough to be under the tax credit threshold, along with a little bit of room to add in some limited extras too, and still qualify for the tax credit. This was an obvious move, a 20% price drop for Tesla, but a massive 31% price drop to the consumer. It wasn't just the Model Y cutting prices in order to qualify for the tax credit either. The Model 3 rear-wheel drive also saw a price drop of $3,000 down to $44,000. However, this would make no difference to any tax credit if the Model 3 does qualify. Therefore, this would lead us to assume that the main reason for these price drops was actually demand. However, the Model 3 is not as a drastic price drop, likely because it may already be qualifying for the tax credit anyway, which could take it down to $36,500. These prices seem unbelievable to Tesla lovers. Who wouldn't now want to buy a Model Y when it costs this much less? Well, I guess now we're truly going to find out just how popular Teslas really are. Although the Model Y price drop seems drastic, let's not forget it was at a crazy price beforehand. Tesla had an insane buffer in their margins, that they had this price flexibility so that if demand did drop, Tesla can lower their prices and still be profitable. However, for the Model Y, Tesla now get $13,000 less profit per sale. This is a big loss. I estimate that Tesla's margins has gone from 39% to 24% for the Model Y in the US now. 24% is still a good margin though. The car is still selling for more than it used to back in 2021 at around $50,000, and Tesla were hitting around 25% margins then, so possibly margins are slightly better now. $53,000 is still a lot for a car. There is still a reasonable amount of margin there. And then the fact they now get $7,500 off is a great deal for the consumer. Before, when Tesla had the $50,000 price tag, they had a waiting list of about 4 weeks. This was in 2021. Now, at $45,500 for the consumer, we might expect the waiting list to start to get some backlog again. This is what everyone should be watching now to see what Tesla's demand is going to be now the cars are reasonably priced and we're no longer in a boom scenario, and where the competition are having supply chain issues. The previous $50,000 price tag is actually pretty much the same as the $45,500 price tag for the Model Y with the credit, as when there was that $50,000 price tag, money cost less, the financing was less. The cost to finance a $45,500 Model Y over 5 years or so now is almost the same as it was when you financed it as a $50,000 car a couple of years ago when interest rates were lower. However, back then Tesla weren't selling as many Model Ys and there were fewer alternatives. So now Tesla have to try and sell about twice as many Model Ys as they can for around the same real cost in an economy that has less consumer confidence, and the competition do have alternatives to offer. Also, don't forget, now hybrids are $7,500 cheaper too in this scenario. I think a lot of people think now that Tesla has lowered their prices, it's a war, and the competition should be scared. If these prices are right, then Tesla will just continue to sell every car they make, just like before. If aggregate demand for autos is down considerably through economic issues, then Tesla will have the same amount of sales in a smaller market. In other words, fewer total sales of cars and the same quantity of Teslas means relatively more Teslas, or a larger market share for Tesla. If Tesla can also ramp up Texas as well, then this will increase Tesla's market share even further. Tesla's demand has been insane in the past, and they had to raise prices unrealistically. I think these prices that Tesla have now set are not some massively discounted price to stimulate demand. I believe that these are more like the Tesla prices we'll be seeing in the future. I think this probably is closer to a market clearing price for Tesla. They still make good margins. Except for Texas, however. Tesla were breaking even in Texas when they hit a run rate of around 2,500 to 3,000 vehicles produced a week. If each of these vehicles now lose over half their gross margin, then I would say that Tesla need to get to volume production for Texas until it makes a profit again. In another video, I will explain how this may be difficult, and that Texas may not be able to ramp much more until the 4680 sales start producing some decent numbers. In the meantime, Texas could be losing about $500 million a quarter. It becomes a cash furnace again. These price drops have also probably removed about $4 billion gross profit from Fremont, possibly a little less. I'll do some financials to show it all sometime. But to give you a rough idea, then with around 2 million deliveries and a margin of 18% and ASP of $43,000, then Tesla will still hit about $15 billion in earnings. And that doesn't include a large profit from energy. That's a forward PE ratio of about 27. This also doesn't include any growth from the new factories. Although it does have Berlin as profitable, it might turn into a cash furnace too, which may reduce earnings by another $2 billion or so for the year. For a really rough guess for Q1, we might be looking at around $3 billion in earnings, which would give Tesla a PE ratio of around 32 at the current stock price relative to that earnings. I'll go into more detail for the numbers sometime. Anyway, now we know Tesla's price points in their two largest markets. Everything we thought that would happen has happened, and we estimated that these would be close to the price points. Now it's up to the consumers to tell us just how popular Tesla will be. If demand still doesn't return, then it could be concerning. Of course, Tesla still need to increase the production in Texas further to a level that would just about double supply of the Model Y in the US. However, the Model Y that Texas is making in order to grow production and supply will be a lower cost version with less range. The new manufacturing techniques should hopefully reduce costs though, and the 4680 cells, if they ramp, should also reduce cost. However, if Tesla doubles supply, that's a lot more cars to try and sell, especially when prices are getting lower. It starts to really affect operating margin. The dilemma is that if they increase supply, all prices have to drop from both factories. Tesla have not found their real equilibrium of supply and demand yet, and a market clearing price that produces the most profit. For example, if Texas ramped up and there were 800,000 Model Ys made in the US, but Tesla could only sell that many by reducing the prices to $40,000 before the tax credit, then there'd be little profit. There'd possibly be more profit from just selling 250,000 Model Ys at $55,000 from Fremont. It would depend on what price the market will buy almost 1 million a year. And Elon has said that he is prepared to do this. Just sell as many cars as possible, even if it's at a loss. Of course, this also upsets customers if their car drops in price the month after they bought it. It may make future customers more concerned. It won't happen to them either. Tesla's products do not have price stability, which may affect consumer confidence. Okay, perhaps Tesla simply don't care about profits and simply want to push as much of their hardware out onto the streets so they can take full benefit of the profit from future software upgrades, or believe they can be suited for robotaxis. I've been of the thought, as many of you have too, that Teslas are amazing. They are the best EV and EVs are the future. On top of that, Tesla are the only ones that are able to make an actual smart car. Just like everyone transitioned from flip phones to smartphones, people will transition from ICE to electric, and especially if they also drive themselves. But is that possibly not what everyone wants, and don't care about it that much? A lot of new cars offer a lot of these features, despite a vastly inferior touchscreen. Have Tesla now jumped from luxury to the low-cost EV company? Is that how they can compete now? Or do consumers want more modern-looking designs, even if it's from a hybrid? Well, now Tesla have shown their hand and put themselves out in the market competitively. We will actually see how Tesla is positioned in the market. Are Tesla just a niche electric car maker that got lucky during some crazy economic times? Or is Tesla setting the precedent of the future of cars? This will be a tough year for Tesla. They need to show growth. The production is still up considerably from last year, especially if you factor in the downtimes Tesla had. But this year, Tesla also need the demand to cover the production. Investors should be much more concerned with the number of cars delivered rather than produced. Then profit margins will be slaughtered by the price drops. Also, remember, we are not in a real recession yet either. This is just Tesla experiencing higher interest rates that are making their products more expensive. In a severe recession, it will be very difficult. How the market might treat Tesla if it's not showing growth in deliveries, and if margins are down considerably, is anyone's guess. It could be brutal, but a lot of it seems to already be priced in. I understand a lot of this is about market share, but Tesla also need to be ramping up production if they want to really increase their presence. They did an amazing job ramping up Shanghai 30% in just a month, but they're really struggling in Berlin and Texas. And again, ramping up supply means lowering prices in order to gain demand for the additional supply, which is the biggest struggle I see for them this year. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.